What is going on, Internet? Eric Van Holt's back again with another e-commerce conversations. I hope all is well on the other side of the Internet. On the other side of the Internet from me, a beer. What's up, man?
Doing great. How about you?
Doing well. Happy Tuesday, day after Cyber Monday is when we're recording this.
Yes, sir.
Yeah, has it been a wild year for you?
I mean, it's had its ups and downs, that's for sure. With tariffs and ad costs ever rising. But no, it's been pretty solid. I think most of the brands that I kind of interface with, they're all they've had their challenges, but things are always kind of moving along. I mean, I don't think the e-com game has been without challenges for a pretty long time. So
yeah, nothing's easy. Well,
yeah.
I'm excited for this podcast episode. You're the first guest in this subject matter that I've had on. So we're going to be broaching some new subjects here. Maybe we've tiptoed around the edges with some of this stuff. But for our listeners who have never heard of you, who the heck are you? What the heck do you do?
Sure. So my name's Abir. I'm a fractional CFO for e-commerce brands. I'm also the co-founder of Upcounting. We're an accounting and CFO firm that specializes in e-commerce brands. So we'll do everything from basic transactional work like bookkeeping all the way up to helping with due diligence, ERP implementations, cash flow forecasting, financial modeling, all that fun stuff. My personal special sauce is that aside from being a CPA and having the finance experience, I used to run an e-commerce brand, and I also used to run a marketing agency. So I have an unusual for a finance person level of familiarity with advertising and like the numbers and the decisions that actually matter to a brand founder. And so a lot of the way that we've structured the work that we do and how we present our metrics to founders and whatnot, and just kind of my own understanding when I work with a brand to help with forecasting stuff, it really brings in a lot of that understanding of everything outside just the pure accounting side. So it gives us a little bit of a unique perspective because obviously marketing is typically the number one largest expense for any e-commerce brand. So it's tough to provide good advice if you don't understand how marketing works.
Yeah. So speaking of giving advice, what is the most, we'll say the most common mistake that you see a lot of operators and founders make from a financial perspective?
I'd say I'll think of three, just because there's a handful of stuff that comes up pretty frequently. So when it comes to just kind of understanding the financial health of their business, a fairly basic one, depending on like how sophisticated your audience is that a lot of times they focus way too much on the wrong metric, or like the not most important metrics, let's call it. So they'll spend a lot of time focusing it on Shopify revenue. They'll if they're a little bit more sophisticated, they'll look at maybe something like contribution margin. Though I can tell you that while conversations around contribution margin, if you're like on DTC Twitter, like everyone there seems to know it, but I talk to a lot of brands that come from outside of that circle, and it's not a common thing in like the regular e-com world. So certainly there are a lot fewer that'll actually pay attention to those sorts of metrics. A lot of them will pay very passing attention. Maybe once a month, they'll just kind of peek at their profit, don't look really much in depth there, and then they really don't pay attention to their cash flow. So I think not really looking through the entire chain of events in your financial statements leaves just a lot of blind spots, and that's very common for a lot of founders that are just kind of focused on revenue in particular. Second one comes down to, I'd say, oftentimes just not really having a thorough understanding of what can be done to enable additional growth for the brand. Because I have that kind of background on the advertising side, it will happen fairly often that a brand we're working with is not necessarily seeing good financial performance. And so one of my colleagues who's working on that file, they'll just kind of flag it to me. They're like, hey, Abir, this brand's kind of struggling. Can you take a look at their setup? And I'll just be like, yeah, sure. Just send me their ad account access. I'll take a look at things and I'll jump on the next call with them, just to kind of give them feedback on that, see if I can introduce them some agencies, give them some advice on kind of like account structure or their spend mix. And very, very often, like people are underinvesting in the creative side. And so what they're doing is trying to achieve growth by just trying to push a little harder on the ROAS, so to speak. So just kind of pushing the revenue a little bit more strongly, but not necessarily actually doing anything to enable the ability to spend more at a consistent ROAS or CAC. And again, that's one of those things that, like, if you're on DTC Twitter, maybe something you're a little bit more familiar with, but the vast majority of brands are just not really aware of that. And the third thing is just with respect to not really breaking up channel performance. It's especially common for omni-channel brands, and it's weird how often I see this. But for example, they'll have a single line for COGS on their P&L that incorporates Shopify COGS, Amazon COGS, and wholesale COGS with no kind of breakdown. So they don't really have that channel level performance reporting. So it just muddies up the visibility of like how your business is actually doing. And obviously with omni-channel, especially with the wholesale side, because of how different cash conversion cycles are and whatnot, it just kind of makes it really hard for brands to truly understand how their business is doing, because you're just looking at it on a very high level, like one bank account, one revenue line, one profit number. But in reality, it's like almost three sub businesses. So those I'd say are fairly common issues I notice with brands that come work with us.
Yeah, let's go back to point number one. There is a lot of focus on contribution margin. Can you
Mhm.
give our listeners like a quick rundown of what contribution margin is and why it is or is not that important to a business?
Yeah, absolutely. So the simplest way of putting it together is that it is the profit that you get from scaling. So the more that you're able to increase your revenue, essentially you take your revenue, deduct all of the variable expenses associated with that. So fulfillment, anything logistics related, obviously the product cost, merchant transaction fees, and then of course the biggest one tends to be advertising or marketing expenditures. So all the variable expenses deducted from your revenue gives you your contribution margin. And the reason that it's an important metric to track, especially for e-commerce businesses, is because of the way that revenue and ad spend can fluctuate quite a lot from month to month. And ultimately, it gives you an indication of how much additional profit will you be able to generate if you continue scaling. Obviously, contribution margin percentage is not perfectly consistent month to month, but it gives you an idea of really what is the profitability of your scaling activities. And that needs to cover your fixed expenses for there to be a profit left over.
Yeah. And what do you see from your perspective as to be benchmark numbers for a well-run e-commerce business? Of course, every business is different, every product's different. So it's I know I'm going to get a little bit of that like it depends kind of
Of
answer,
course.
but if you were building, let me rephrase this. If you're building a perfect e-com business, what would be your targets?
I'll give you a stepwise it depends answer, because yeah, it is going to be a little bit of it depends. For let's say a regular e-commerce brand that's primarily acquisition focused, so they don't necessarily have a huge amount of retention. So let's say sub 20, maybe sub 10%. I'd say if you're running at a contribution margin percentage of say 20-ish%, you're probably in decent shape and you're able to kind of run things. Obviously, you have to be lean enough to be able to generate a profit, but that'd be pretty good. I think the reason the it depends is particularly important is that once you get into the game where you have a significant amount of retention, or if you have subscriptions, all of a sudden it's a very different approach. You almost don't even pay that much attention to contribution margin. You start shifting your attention a lot more to LTV to CAC ratio, because that becomes a lot more important for whether or not your brand is able to scale. And then if on top of that you have funding, so you don't have the cash flow concerns, then you really can heavily focus on the LTV to CAC. So you can go super negative on your contribution margin as long as the LTV to CAC ratio makes sense, because the contribution margin is going to kind of make sure that you at least have cash flow coming in. But if you got funding, like some of the brands we work with do, even that becomes less relevant. So I'd say it's a bit of a function of kind of what your structure is business wise. But broadly speaking, again, just to give some rough ideas, if you can have a contribution margin above 20%, that's a good thing. If your returning customer contribution margin can cover your fixed expenses, then that's good, because then you can be a lot more you can be break even or even a little bit aggressive on the new customer acquisition side. Ultimately, you want your LTV to CAC ratio to be maybe a 3 or higher. And that's after, I guess, all the variable expenses. So consider your lifetime gross profit to CAC ratio, because that at least means that you have an opportunity to kind of scale and take the business towards an exit. But you might want to be a bit more conservative if you are bootstrapped.
What do you
That,
consider lifetime value? Is that 9 months, 12 months?
um, I I try to aim more for 9. When I do come up with a target for a brand that we work with, the two main things I'm looking at is when we look at kind of the burn down chart, or like the retention chart. Essentially, we pick a place where it plateaus. So where it starts to seem like it's hitting an asymptote, like at that point, we're like, if it tends to go on for 24 months, we're like, maybe 9 to 12 months is maybe where we're going to go, just to be a little bit more conservative. Also comes down to how much data they have. If the brand's only 3 years old, I'm not going to take a 24-month view. I might lean a bit more towards 9. And it also comes down to their cash flow, because at the end of the day, even if you can make a shit ton of profit after 24 months, if you just don't have the cash to, if your break even is after 12, and you don't have a lot of cash that you're sitting on, you have to take that into consideration. But rule of thumb, I'd probably aim somewhere between 6 and 12 months.
Okay. And then uh, what should entrepreneurs, operators be doing from a financial standpoint? Like, should they be looking at the numbers on a daily basis, weekly basis, monthly basis? What are kind of your best practices for someone running a company?
It comes down a bit to the, I'd say, level of complexity of the business, or the size and how much is going on, and then also what their ambitions are. I'd say that maybe think of it in 3 layers, looking at just kind of the historical data and how things are performing. Most things I think you should be looking at on a weekly basis, just kind of getting a sense of like what expenses are kind of going through the business, how your cash flow looks. In terms of the more in-depth reporting, something a little bit more sophisticated and kind of broken down, that oftentimes will be easier to look on a monthly basis. And as long as you're not, being crazy aggressive about the scale, usually that should be covering most things. And I think the third piece that a lot of brands neglect, but in fairness, it is kind of a difficult thing to do, is the forecasting and the future, like the planning side. So any sort of modeling or forecasting, looking into the future as to like what will be the consequences of scaling in one way or the other. I think that's something not enough brands do. If you are scaling very passively, or like kind of just playing it safe, maybe a little less relevant, but I've come across a lot of brands that are pretty aggressive, and then they're just raw dogging the future. They have no plans, no forecast, nothing. They just hope for the best.
Yeah, I mean, it's I kind of I guess I got in a debate about this. Like,
Hmm.
I don't, me personally, we don't really set like targets or goals to go
Hmm.
after. Um, and so you're constantly kind of looking backwards to see what you've done, to make an estimate of what you're doing in terms of inventory requirements. How long is it
Hmm.
going to take to make your products? And then how many, in my world, it's like if it takes me 3 months to make a product, I want to have no more than 3 months of inventory and then just be buying all the time, kind of
Yep.
cycling through that. So being nimble from an operations standpoint kind of just gives a little more flexibility and focus on that end rather than this target. But one of my Twitter, I'm not going to call him a beef or anything, but just like the opposite of me arguing is like, of course you have some kind of targets, right? Like you
Hmm.
you just don't go in blind. And I think there's maybe the disconnect is more of like tying my identity towards targets and
Hmm.
what we're hitting, and whether or not I'm successful or not successful, and the opposite of using information you need to functionally operate your business. Because I feel like an entrepreneur in the numbers, especially if you spend time on D2CX, can be uh, an ego, uh,
Sure. Yeah.
an ego mess up. Like it's, you see everybody posting their wins. You see, people who are maybe not as gifted as you, more successful than you, um, or maybe the opposite. Maybe you're not very gifted. Um, it, I don't know where I'm going with this, but numbers are a funny
Yeah.
thing, and I think it's do you ever get to the point where you see founders having trouble separating their ego from the numbers and instead, boiling down to what's really important with the business?
Oh yeah, absolutely. It's funny. I was explaining this to my team the other day, that one of the challenges with working with some of the, arguably they're the more fun and ambitious brands that we have in our portfolio, if you will. But one of the challenges with them is that when things aren't necessarily going as well, it's hard to convince them to pull back on the scale, or to like take their foot off the gas pedal. I'm thinking of this one brand, for example, that I started working with not too long ago. So they're pretty, they've got heavy retention. They're a subscription brand, so generally like customers stay for a long time. And to a certain extent, they were kind of taking a little bit of an MER view to how much they could spend on advertising. And they did fantastically well in 2022, 23, 24. CACs were very good, so their LTV to CAC ratio was pretty healthy as well. 25 has been a lot more difficult. And as a result, while their MER looked good, their CAC was crazy high. And the thing is, I was trying to explain to them and trying to get them to accept, like, look, I know that you guys are spending so much because you want to keep growing the business. And I understand that it's not nice to hear that your CAC is too high and that you're actually acquiring customers at a loss. Like, you'll never actually recover from an LTV perspective what you're spending on the CAC perspective. And I know it doesn't feel like you're that unprofitable because your losses are very small and your MER is so good. But that's only because everything you're doing in 2025 from an acquisition standpoint is subsidized by the retention revenue from 22, 23, and 24. Like, all those customers that you acquire cheaply, they're still, or a lot of them are still here. They're bringing a lot of contribution margin. All the new ones that you're acquiring, they're pretty much at a loss, or a big chunk of them are. And so I had to convince them to really like pull back on the spend to try to get their CAC under control. But it was very difficult because for them that feels like their business isn't, on that constant upwards trend, like they're not necessarily growing. And it's a conversation that happens a fair bit because, especially for people who have been winning for a while, it's very difficult to accept that like the wins have stopped. So those adjustments
Yeah.
are hard.
Well, I mean, like how much, at what point, because it seems like costs are always getting higher, right?
Yeah.
It's always more expensive to acquire a customer, especially as you hit some kind of scale. At what point are you like, well, we need to figure out how to acquire customers more effectively, keep it going? And at what point are you like, well, this is what the market can handle on this channel. We need to pivot to a new channel.
Yeah, that's a good question. It's a tough one to really know for sure. I would say in the vast majority of cases, my inclination is always to think, and especially I'll take a look at the ad accounts and kind of just give it a little bit of a judgment call. But most of the times I don't know that the brands have ended up saturating a channel, especially if it's Meta primarily, because there's just a lot of room to go on Meta. And I'll see one brand kind of, again, maybe in the supplement subscription space, spending, call it 200K a month on Meta. And then they're on like 7 different channels as well. They'll be like doing podcasts and TikTok and, affiliate and all this other stuff. And then I'll have another brand also in supplement subscription space spending 200K a day on Meta alone. And the thing is that, like, product wise, like, there's not any dramatic difference in terms of like the type of product, their avatar, the quality, the branding, how long the brand is, if anything. And it really just comes down to like, one is going like violent volumes of creative, and the other one's like, using a 2022 playbook essentially. And so most of the time I feel like the advice I end up giving to the brands when I kind of poke into their machine, it's like they're just really, really underfunding the creative strategy side of things. But certainly when they get to a certain point, it can make sense to kind of diversify a little bit. But a lot of times there's just a lot more room on Meta. There's a lot of the brands haven't caught up on that front. Again, especially when they're not DTC Twitter types, because on Twitter, everybody kind of gets that idea, but not the real world.
Okay, so let's dig into that allocation to creative. You
Mm-hmm.
want to go from 200K to 200K a month to 200K a day. What is that? 30x increase in spend.
Yeah.
Is it a 30x increase in creative? Like, what does that look like from your perspective?
I it's a I wouldn't say it's a 30x increase in creative necessarily, because there is some level of a trade-off between volume and quality. So it's not about just kind of like taking a bunch of like just randomizing ads and just chucking it in there and seeing what sticks. So to a certain extent, it also depends on kind of like the brand's strategy from a marketing perspective and how much they want to go into like the more, I guess, elevated branding or ads, if you will. But I would say that you generally probably have to 5 to 10x at least to be able to do that. The way I kind of explain it is that you just need more creative running through the machine to be able to find additional winners and new pockets of audiences that are going to respond to your creatives. So you can say, if a certain level of creative generation has, let's say, gotten you to plateau at around 200K a month, to be able to get to, say, 500K a month, you're going to have to increase your creative volume, period. If you 2x your volume, you might take 8 months to get there. If you 3x your volumes, you might take 6 months to get there. If you 4x your volume, you might be able to get there in 3 months. And obviously, it's a little bit of a function of how lucky you get with your creative and how good your strategy is. So how much you're able to increase your volume from 2x to 5x or 10x, that's also a function of how profitable you are and how much money you have to reinvest into the machine. But generally speaking, it's a little bit of that trade-off between kind of like speed and then how much height you can get. But most brands that I take a look at, I'd say they probably have room to like 3 to 5x the volume of their creative.
Okay, so let's break that down from a financial perspective. Let's say we have a brand, they want to focus on Meta to
Hmm.
grow, only Meta.
Hmm.
You're going to need someone to run that account, right?
Hmm.
How eh, how much is that person going to be? Is that an agency at $5,000 a month? Is it an in-house person at 10K a month? Like, what are we looking at for someone who is the driver of the account?
It will depend a little bit on the spend levels. I'd say most brands are probably better off working with an agency, especially if the agency is also doing creative. So let's say it's an agency that does some amount of creative as well. You're probably looking at somewhere between 5 to 10-ish K, maybe 5 to 7K, something like that. I try to keep that below 10% of spend where possible, but does depend on obviously the scope of their services. So if you can keep that below 10% of spend on that primary kind of media buying agency. And then usually I say just supplement with other creative agencies that you can kind of cycle through. So just have a few of them in the stable, kind of work with them. Once their creative starts falling off, find a new one, and that way you just get the most amount of diversity in the account.
Okay, so we're targeting 10%. What if you're a small brand, you haven't hit that seven-figure
Mm.
mark, you're trying to get to that seven-figure mark? I mean, 10% is pretty much impossible.
Yeah,
If
no,
you're only spending, 20K a month or something like that.
100%. So if you're going to work with an agency at that point, then you're probably going to have to accept being at like 10, 20, 30% even, depending on how much spend you've got in the machine. But you also, I mean, ideally, honestly, brands that small, it really should be the founder who's kind of like at the very least getting a decent idea of the marketing side. Media buying isn't as hard as it used to be. So at a minimum, kind of like having a bit of an understanding on that front to be able to kind of make sure they have at least an opinion as to whether or not a good job is being done. But yeah, realistically, especially if you're somewhat new, you're just kind of getting off the ground, then yeah, you could be spending 20, 30%. You just don't want to be stuck there for too long because it's obviously not sustainable.
Right. And then what kind of expectations would you have for, let's say you are working with an agency, you're doing 50K a month, paying
Hmm.
5,000 bucks. What kind of creative output would you expect from that agency?
Hmm.
And then how much would you have to supplement it in terms of your budget for that?
It's a good question. I'd say I don't know, maybe agencies will disagree because like I know this is kind of a hard number to peg down because it's a function of the quality of the creative. But if you're paying an agency about 5K a month and you're spending about 50K a month, you probably want 4 to 8 new kind of concepts being launched in the account each month. So like 1 to 2 per week. And at that point, I'd probably at least have one other creative agency that's like just focused on like performance creative kind of coming into the account. So that way you have a little bit of that diversity. As you scale up in ad spend, then you might be able to add a second and a third creative agency. And then it's just a question of kind of cycling through them as necessary. If they're doing great, then keep them. But obviously, if they kind of hit a bit of one of them hits a plateau, then just replace them with another one, that kind of thing.
Yeah. What are the best practices for finding these agencies? And how do you hold them accountable? What are the metrics that you want to hold them to ensure that you are seeing the results you're looking for?
I say in terms of finding them, it would be a combination of referrals and then also just kind of looking at their portfolios. In my case, like a lot of the brands we work with, I'm fortunate enough that I get to see a lot of like the actual profits driven by the work that the agencies do because we see kind of like the financial impact. So I often have like very good referrals that I can make to the brands that work with us. But if a brand doesn't necessarily have somebody who can send the referrals, then kind of looking at an agency's portfolio, seeing the type of creative that they generate will at least give you a little bit of a gut feel as to whether or not they can do good work. But then once you've actually kind of started to decide to do like a test run with them or a couple of months or whatever it is, I'd say you just want to make sure that you have a decent amount of volume. You want to have a pretty robust naming structure in the ad account to actually track the performance. And it's helpful to have more than one creative agency or so, whether that be yourself or your media buying house or another creative agency. It's good because then you can kind of compare, because otherwise it's hard to know whether a creative agency is doing a good job or not if they're running ads in isolation, because you don't know if the problem is their creative or just your product sucks or your website's bad or whatever the case might be. So having like a naming convention or a structure to kind of see the performance from one agency to the next will kind of help determine if they're doing a good job. And usually you can get a good sense within like in less than 3 months you'll know if they're doing good work or not.
All right, let's get into the unsexy part of finance. I don't think I've ever heard one entrepreneur tell me they got into business to do bookkeeping.
God no. Unless they're a bookkeeping agency, I suppose.
Yeah, yeah. So, and not only that, I feel like so bookkeeping is like a cost center. It's not
Hmm.
driving any revenue. And when you, or at least from my experience, whenever I listed to hire a bookkeeper,
Hmm.
this was years ago, it was
Hmm.
incredibly difficult to find talent
Yeah,
as well at a reasonable rate. So, how do people manage or budget effectively for their bookkeeper? How much should they be spending on those services? And I don't know, maybe break it down between a one channel brand to a multi channel brand to like a fairly large business with multiple vendors and um, a
sure.
higher demand.
Yeah. The tricky thing is that when you are small, there's kind of almost this like minimum cost that you have to incur to be able to work with somebody, especially if you're going to hire someone in house. Like, I generally don't recommend it. And I know I'm biased, but like, I have a very good reason as to why I don't recommend people hire someone in house until they're like massive. But I'd say that if you're, let's say you're doing somewhere between 1 to 5 million, if you're single channel, like just Shopify only, you should be able to get away with something like 2 to 3K less if you really are fine with kind of the lower quality of work, maybe lower quality of communication and whatnot. You could probably go below 1,500, below 1,000. I think the challenge becomes to a certain extent if, like you said, a founder doesn't get into the business because they want to be like an accountant or anything like that, if you don't necessarily have an understanding of what financial data looks like when it's clean or done well or anything like that, you can skimp on a person to pay for that. But the problem is that when they have questions, they're going to come to you, and if they don't do a good job, you won't know it. It's kind of like hiring an IT cybersecurity person when you have no idea how IT works. Like, you don't know if they actually set anything up or did anything right. You're only going to know when there's a problem. And with the sheer like volume of clients that we've taken on from who have like either tried to do stuff themselves or worked with kind of like cheaper solutions, more often than not, a lot of the data is wrong. And the idea being that, I mean, I agree with you. Like, I don't really actually like my dirty little secret is that I don't actually like accounting that much. Like, I don't care for accounting for the sake of accounting. The only reason it's important is because it's data to help you make better decisions. And the problem is that if you're getting it done, but you're never going to look at the data or use it for decision making, then yeah, find the cheapest solution possible. Who cares? You're just trying to get something done that you can file with a tax authority. But if you're at a level where you're trying to make decisions and you want to push the envelope a little bit more, you want to scale a little bit more aggressively, then you need cleaner data. You need to make sure it's done properly, it's done on time, and you want to be able to get good advice about how to interpret that data if that's not necessarily your forte. So at that point, if you're kind of scaling past the 5 mil, you're in the 10, like in the 8 figure range. So now you're kind of getting a little bit more serious. You probably should be spending somewhere between 5 to 8K or something like that, especially if you start adding additional channels like Amazon and wholesale. But that should then carry you pretty far. Like, you could probably get to 9 figures off of like 10-ish thousand dollars a month, because it doesn't really scale linearly with revenue in that sense. Obviously, complexity matters. So if you start building out your own fulfillment warehouses and your own manufacturing, like, that's then a huge step forward. If you start implementing really complex ERPs, big step forward. But again, we have 9 figure clients that are able to kind of have their entire stack handled by us because their complexity is not necessarily that level. They're just big and making a lot of money.
Yeah. Yeah, I mean, like paying a single invoice, whether it be 10,000 units or 1,000 units, is the same amount of work. So
Exactly.
it's just another zero on the end of it.
Hmm.
You guys do a full stack. You say like accounts receivable, accounts payable, bookkeeping, and then CFO, fractional CFO.
Yeah, pretty much everything. I generally try to avoid doing payroll just because that's a little bit more like sensitive with respect to employees and stuff. But yeah, pretty much all of it.
Okay, and then is bookkeeping and accounts receivable, accounts payable kind of they go hand in hand, or do you see people separating those out?
For the most part, they're kind of all adjacent. At a certain point, it becomes a little bit of a nomenclature thing. But yeah,
Yeah.
I'd say they're kind of all within. The way I call it is just transactional work. So you can call that bookkeeping or accounting or part of AR or AP, but it's all just the transactional side of things. So it's just making sure that the right numbers go in the right boxes.
Yeah. Now, is your team located globally, or are you building an in-house kind of Western team?
Both. It's global. So we have people in Asia, in Europe, in the States, in Canada, all over the place. I'd say maybe 50-50, kind of like Canada, US versus offshore.
Yeah. So, I mean, I guess the argument is like, why should someone not hire someone in the Philippines for $1,500 a month to
Mhm.
handle all this, and versus going to an agency paying $2,500 for it?
Uh, so I can give you a bunch of reasons, but generally, if they can find the perfect person who can do an excellent job and doesn't make any sorts of mistakes and able to kind of do all the work themselves, and they never have to ask questions of founders, then fantastic. I'd say that number one, it's very difficult to find good talent in our field, in like the accounting industry. I do an insane amount of hiring, and I'm an accountant, so like I know exactly what to look for, how to hire, what questions to ask, and how to judge if they actually know what they're doing or not. And it's still very difficult. So I've had a lot of brands that I've talked to that like we'd have a conversation, then they'd be like, "Oh, we think we're going to hire someone full time," and then like 6 months later, they reach out to me like, "Oh yeah, that person didn't work out." I'm like, "Yeah, it's not easy to find people even for me, and I have a whole machine around hiring." So firstly, it's hard to find a good person. It's hard to identify if they know what they're doing or not. It's also difficult to be able to scale them because you're either going to hire someone junior and hope that they can do more complex stuff, or you're going to hire someone senior and then make them waste their time on really junior things. The benefit of kind of working with a fractional finance department is that you get multiple resources on the file and just enough of time from each person to handle the thing that's at their caliber of complexity. And at the same time, very few people out there know e-commerce well. Was kind of one of the main reasons I even kind of decided to move from like brand running and agency doing to just kind of focusing on finance side, because there's a lot of nuances to doing e-commerce very well, and most people don't really have that. And then it's the ability to be able to kind of scale up. So if one day you need help with an ERP review or with your inventory costing or with forecasting, that's all stuff that we're able to kind of just slowly scale into as it's needed.
Yeah, so let's kind of talk about the ERPs. I
Hmm.
assume you work with anyone who's using Intuit. They've been around forever.
Sure.
There's some new software tools that focus on the e-com space, and I forget their names, but I'm sure you have. Do you have any skin in the game? Do you have any dog in the fight?
Not really. I mean, obviously, QuickBooks and Zero, like those are the most common ones. NetSuite, I know sometimes gets a lot of hate. It's one that I know pretty well that I've worked with for years. I've done many implementations. Has a lot of weaknesses, but I know it, and I get its strengths and weaknesses. Working with something like Fulfill, that one's a little bit more kind of like e-com designed, if you will. So that's a strong one. A lot of times, though, most brands can handle working with QuickBooks Online plus just an inventory system, and like that'll get them very far. So like you don't really need like a fully fledged ERP like a NetSuite, until you're there's a couple of considerations. Like if you're doing your own fulfillment, if you have your own manufacturing stuff like that, like then it can make sense. But if you use a 3PL, you can get to realistically you can get to nine figures on QBO plus just like an inventory management system like a Luminous or a Finale or whatever it is. Most people who get into the ERP game, it's just because they have process problems that they're hoping the ERP can solve, and then they just end up having a lot of headaches by having to deal with a super expensive implementation and all the problems that an ERP can bring.
Yeah, we ran into that problem, many years ago when we were looking to, the software to solve all of our problems, and then
Yeah.
we found out it didn't have the one thing that we needed it to do, and it was just, might as well just be using Excel spreadsheets, and we've been
Yeah.
running off
Yeah.
of Excel spreadsheets pretty much for the past 5 or 6 years. So,
Mhm.
uh, I don't even know. I've never even heard of those. What are those inventory management software tools? What do they do well?
So they all have different strengths and weaknesses, but essentially, to put it simply, they do a good job of keeping track of inventory that's kind of coming in, the costs associated with them. If you do first in, first out or average costing, so essentially giving you a good, accurate cost per unit, calculating your COGS for each month, tracking the different SKUs that you have at different locations. So how much you have at FBA, how much you have at this 3PL, how much is at your manufacturer. If you do any level of co-manufacturing, so you have some raw materials, packaging, labels sitting in the manufacturer, you want to keep track of that kind of stuff. If you, tell the co-man to create a certain amount of finished goods, then it keeps track of how much did you reduce on each side. So it just gives you very good visibility and costing into inventory volumes and values. And that's just very necessary to kind of keep track how things are going. And then, of course, forecast out for making sure that you have, stuff in stock for when you need to do purchasing.
Well, what do they charge for their software? You know?
You're probably looking somewhere in it's going to be a broad range because it does really depend on kind of functionality, but I want to say 500 to 5,000 a month.
Okay. Where can people support you, hire you, follow you?
The internet mostly. So I'm all over the place: LinkedIn, Instagram, TikTok, Twitter. On TikTok, or sorry, Twitter, I guess the easiest one would be a beer underscore CPA. And then the company name is Up Counting, just the word up and then the word counting. So Googling that you'll see a big picture of my face when you go to the website.
What's your perfect client?
I say just e-commerce brands. Typically, if they're doing, like 3 mil plus, usually they're in good shape. Shopify first, but we're pretty flexible. Like we have anywhere as small as Shopify only at 3 mil to over 100 mil doing Shopify, Amazon, and wholesale. As long as there are people who appreciate good data and want to and ambitious, have the goal to scale, we're able to kind of support them, and they're more fun to work with.
Sweet, man. Well, I appreciated having you on the podcast to kind of talk about the unsexy parts that are also like at the core. I'm going to wrap it up with this one saying is like, what person would you want to hire to run a company? And it was like a sales guy, a marketing guy, an ops guy, and a finance guy. And it's of my belief that the finance person is the most powerful person within the organization, or the person who understands the numbers, because without really understanding what things are going to cost and what kind of revenue they're going to drive, what kind of profit they're going to drive, you're just you're driving blind. You're driving blind. It all starts with finance. So I want to echo, the work that you do is incredibly important and vital, and usually going to be the unlock for a lot of brands who haven't invested that time and energy into their numbers to make sure that they're actually making money.
At the end of the day,
Guys,
it's all about decisions. So, yep.
yeah. Guys, this has been another e-commerce conversations. Hope you enjoyed it as much as I did. Cheers. Keep on growing.